So, is it time to actually fire your financial advisor? Welcome to The Explainer. Today, we're unpacking a really fascinating and honestly a bit controversial new academic study by researchers Oler and Horn. They basically set up the ultimate showdown. They pitted 17 giant, heavily funded bank robo-advisors against, well, a single completely free AI. Yep, ChatGPT. And the results? Let's just say they might completely change how you look at your portfolio from here on out. It really begs the question, doesn't it? Like, are you actually still willing to pay those super expensive bank admin fees just to have them manage your investments? Because what we're looking at today is literally the ultimate David versus Goliath story of modern finance. On one side, you've got these massive legacy banking institutions. And on the other, free tech that's literally sitting right there on your smartphone. The research we're diving into shows that everyday retail investors, especially millennials and Gen Z, you just don't need to be ultra-rich anymore to access what the industry calls smart money. Okay, let's dive into this. To really understand why this massive shift is happening, we've got to look at the gaping flaws in the platforms we already have. There was this other huge study by Schur and Lehner, right? They looked at over 243,000 portfolio recommendations from 16 traditional German bank robo-advisors. And what they found was kind of wild. These bank algorithms are surprisingly rigid. They totally ignore absolutely crucial human factors, stuff like your specific human capital, your shadow assets, or your own highly nuanced risk preferences. Basically, they just shove you into a box. And usually, it's a very, very expensive box. But ChatGPT, it processes natural language, so it can actually take your wonderfully complex, specific life situation and dynamically customize its advice just for you. Which brings us to this frankly shocking piece of data. Out of the 17 major bank robo-advisors that Oler and Horn tested across all sorts of risk profiles, guess how many actually met the strict academic benchmarks for sound financial advice? 3. Just 3. But here is the kicker. When they ran those exact same scenarios through ChatGPT, the AI actually passed the benchmarks for all of them. Every single one. The researchers put it super bluntly. They wrote, ChatGPT provides better financial advice for one-time investments than robo-advisors. Now, hey, just to be absolutely clear, we are strictly impartial here. We're simply reporting the academic findings of this study. We are definitely not offering financial advice, and we're not telling you to literally go out and fire your advisor today. But man, we absolutely have to acknowledge that these academic results, they represent a massive, game-changing upset to the traditional financial system. So how on earth did a free chatbot beat billions of dollars of institutional banking infrastructure? It's honestly mind-blowing, but it all boils down to AI's secret weapon, the transformer architecture. Because, this doesn't just happen by magic. It entirely comes down to the underlying tech that powers these large language models. See, before transformers, AI basically had to read text sequentially, just word by word. But the transformer uses what's called a self-attention mechanism. Think of it like this. Instead of reading a really dense financial news page one word at a time, the transformer essentially reads the entire page all at once. It's weighing the importance of every single word against every other word simultaneously. And that's exactly what allows it to spot these hidden patterns and figure out exactly which piece of information is actually going to move the market. And this brilliantly illustrates why the results of this architecture are just undeniable. In a study by Futuros and colleagues, where they were analyzing Forex market sentiment, ChatGPT 3.5 didn't just beat the legacy bank models. It actually beat the previous state-of-the-art financial AI, Finbert. They use this thing called zero-shot prompting. That's basically where you just tell the AI to act like a Forex trader without even giving it any prior training examples. And even with that, ChatGPT showed a massive 35% improvement in sentiment classification accuracy. It literally understands market-moving news better than the very tools that were built specifically for finance. Crazy, right? But hey, understanding text is really only half the battle. Let's shift gears for a second and look at complex market forecasting. We're talking about what academics like to call a market time machine, long short-term memory, or LSTM neural networks. Because if transformers are the ultimate readers, LSTMs are the ultimate pattern trackers. They're specifically designed to capture those long-range dependencies hidden inside super chaotic time series data. Now, to prove that this AI stuff isn't all just a flashy buzzword, academics rely on a really strict mathematical methodology. It's called forecast value added, or FVA. And FVA completely cuts through the hype. It basically forces us to step back and ask, okay, does using this wildly complex neural network actually add any measurable value? Or are we better off just guessing that tomorrow's price is going to be the exact same as today? Well, the research shows that when it comes to complex, nonlinear market data, the answer is a resounding yes. Let's take a quick look at this algorithm face-off. We've got LSTM over here, and it handles the total chaos of nonlinear dynamics beautifully. But actually, let's be real, it's not a silver bullet. Studies show that much simpler statistical models, like ARIMA, or tree-based models, like random forest, can still win out in specific linear environments. Like in one study trying to predict Bitcoin prices, the simpler ARIMA model actually outperformed LSTM. So the absolutely crucial takeaway here is that the smartest money knows having the right tool matters way more than just having the most complicated tool. Which brings us right to the climax of our analysis today, the new era of quantitative trading. I mean, think about it. What actually happens when you combine the incredible reading comprehension of large language models with the raw predictive power of advanced neural networks? Well, you basically unlock a whole new world of automated, high-level trading. Now, what's really interesting about this slide is this frankly staggering number. There was a study by Hung and colleagues where they proposed a deep reinforcement learning algorithm for trading. They called it Deep Sarsa. And when they let this thing loose on the NASDAQ 100 dataset, running all the way from 2008 to 2022, it achieved a cumulative return of 582.17%. Over 500%. It just completely outpaced your traditional buy and hold strategies simply because it could dynamically adapt to whatever the market was doing. It pulls this off using what we can basically call the smart money arsenal. See, these AI agents use something called continuous action spaces. That's just a fancy way of saying they don't just decide whether to buy or sell, they simultaneously decide exactly how many shares to trade in order to perfectly optimize risk. Plus, they use dynamic strategy switching. If the market is clearly trending upwards, boom, they use momentum strategies. If the market starts crashing, they instantly pivot to mean reversion. Guys, this is the true democratization of finance. It's taking the exact algorithmic tools that used to be locked away inside elite Wall Street hedge funds and putting them right into the hands of everyday investors. But these AI agents aren't just playing around in the traditional stock market anymore. Let's pivot for a second over to where things get truly cutting edge. We're talking about the evolution of decentralized finance, or DeFi. DeFi is basically ultimate playground for AI, and here's why. The entire ecosystem is built on programmable, composable smart contracts. Because it's literally all just code, and AI can instantly assemble these incredibly complex lending and trading strategies without needing a single human middleman. There was actually an academic study where a deep Q network agent ran statistical crypto arbitrage, and it pulled in an 18.39% annualized return with a 2.43 Sharpe ratio. Now, to put that into perspective, that means it generated fantastic returns while maintaining shockingly low volatility. On a risk-adjusted basis, it significantly outperformed benchmark assets like Bitcoin. It's a total game changer. Now, as incredible as all of this sounds, and it is incredible, we really need to hit pause for a second and look at the warning signs. You've got to watch out for smart machine risks. We can't just get blinded by these massive returns. We absolutely have to weigh the immense risks involved. There's still some incredibly rigorous academic and real-world challenges facing AI in the financial sector. So here is the reality check. First up, AI hallucinations. We all know large language models can very confidently invent plausible-sounding but entirely fake financial data. In the world of finance, that is a massive regulatory nightmare. Then you've got the whole black box problem. A lot of these deep learning models literally cannot explain why they just made a specific trade, which makes legal compliance almost impossible for heavily regulated institutions. And finally, market regime shifts. Think about it. A model could be perfectly trained on the last 10 years of historical data, but then it can fail spectacularly when some unprecedented global event happens and completely changes market conditions overnight. Which leaves us with this final, really vital question. The democratization of smart money is undeniably here. The barrier to entry has completely fallen. And right now, free AI tools are legitimately outperforming billion-dollar banking algorithms in rigorous academic tests. But knowing the complex risks and the whole black box nature of these decisions, are you actually ready to let an AI manage your money? It is a brave new financial world out there, guys. And I highly encourage you to keep learning about this rapidly evolving landscape. Thanks so much for joining me on this explainer, and as always, keep questioning the status quo.